Good afternoon, everybody. It's Greg Schnell. I am here with Martin Pring for the market roundup at the end of September, starting the fourth quarter, October 1. Mr. Pring, good morning. How are you?
I'm great. Thank you very much, Greg. I hear you've been busy with a website.
Martin, I am trying to get that up and running. I'm a little baffled by all of the intricacies of trying to work through payment structures and subscriptions and all of that. It's taking me more time, but I'm hopeful that we'll have something shortly. So yeah, I'm trying to get it working. gregschnell.com. So
What's going to be on it?
you know, I have been building out a newsletter on a weekly basis for some money portfolio managers, and I'll make it widely available to retail investors or private investors at a reduced price, and then try to work through a package for institutional investors. But the big thing I'm trying to promote is a better analysis of my market timing. I get lots of compliments that I seem to do a good job of noticing when markets are weaker, kind of before most other people. And so I think some of the indicators I've got have been working pretty well, and might help people protect their capital a little bit more. So that's one of the things I've got in there, but I've got quite a few others. It'll include the weekly video. It'll include chart list people can go check up. So quite a bit of stuff. Yeah.
Sounds like something worth checking out to me.
Yes, thanks, Martin. And how many years have you been doing IMR now?
Since 1984, under different titles.
The Intermarket Review since 1984. Have you submitted? We need to get you to put a copy of each one together and submit that to the Baruch Library in New York. That is a testament of work there.
Well, the Library of Congress used to have it, but they've stopped taking it now because of the budget cuts.
Is that right?
Yeah.
Isn't that odd?
Well, we got a lot to cover here, Greg. I think we ought to get started.
Okay, let's get rolling, Martin. What have we got?
Well, to summarize today's presentation, I think there are some tentative signs that the slowdown is ending. And I should have underlined the word tentative. It's not decisive yet, but a couple more months of some of these really long-leading, forward-looking indicators are going to suggest that we're coming out of the slowdown. They certainly don't seem to suggest at this point that we're headed towards a recession. And I still think that the long-term technical indicators for the US stock market and the global stock markets, they're still pointing to a bullish outcome for stocks. Bond yields are overstretched on the downside on a primary trend basis. And when they've been like this before, and reacted to the upside, initially that's been good for stocks as well, because rising bond yields have indicated a firming economy. And as you know, stocks are very much tied into the economy. Commodities at this point, I'm watching very, very, very closely, but I still don't see enough signs to say that we've ended the primary bear market. But there are a couple of leading indicators that we'll get into during the presentation that have a tendency to lead commodities, and they're starting to look a little firmer. And finally, I think a very important point here is, we had this oil supply disruption in Saudi Arabia. We've had impeachment possibilities brought to the fore. And to me, and the market hasn't sold off. It's actually gone up a little bit. So to me, these kind of things are providing the wall of worry. And if the market wanted to sell off, so far it's had every opportunity to sell off, and it hasn't done so. So from a contrary opinion point of view, it seems to me that prices are probably headed higher rather than lower. But I also recognize the fact that some of these long-term indicators are bullish, but not decisively so. And it wouldn't take much, especially in October, to turn these things these indicators into a negative mode. I don't think that's going to happen, but I'm certainly not going to be foolish enough to rule it out. So let's start off looking at the global economy. This is the global stock market. This is the MSCI World Stock ETF, the ACWI. And underneath is a leading economic indicator, data for which is put out by the OECD. And they also include 6 other countries that aren't OECD members, including China. Point here is we've got some vertical green lines. Those are flagging the lows in the indicator. And when the economic indicators, the leading economic indicator starts to rise, look what happens to stocks. If we look to the right of all these vertical lines, you'll see that the stock market invariably goes up. Global equities invariably go up. Sometimes they might go sideways for a while, but usually it's an upward path. There's one exception in 2001 when the world economy fell into a recession, but the stock market and then came out of the recession, and the stock market refused to pay attention to that because it was discounting the tech bubble, because things have got very much overdone on the upside in the technology area. And as technology had a large weighting in the index, it had the effect of dragging it down. You'll also notice that during this false signal that the ACWI never crossed above its 12-month moving average. Compare that to the current situation where we don't yet have a bull signal. We're oversold, but we don't have or overstretched on the downside. We don't yet have a bull signal, but the market itself is holding remarkably well above its 12-month moving average. If it starts to cross below the moving average, then I get a little bit concerned. One of the reasons I'm optimistic about global equities is this chart here, which features my global diffusion indicator. What that is, it looks at all the individual country indexes in local currencies and figures out whether they're above or below their 24-month moving average. And if they're above their 24-month, if they're all above their 24-month moving average, or most of them are, we get a very high reading. And if most of them aren't, we get a very low reading. And of course, when most of them are below their 24-month moving average, that's the time to be, and starting to reverse and get across, that's the time to be looking for a buy signal and for looking for higher prices. Once again, the vertical lines flag the lows in this indicator. And if you look to the right of these vertical lines, you'll see once again that in virtually every situation, in fact, in every situation, market goes higher over a 12, 15-month period. We never got that buy signal that we got with the global economic indicator, but we now have a buy signal in the last month with this indicator going bullish. In the last month's presentation, I showed you a similar indicator using an 18-month as opposed to a 24-month. That had already gone bullish, and now we're seeing the longer-term indicators start to turn up as well. So that encourages me. In the US stock market, one of the most bullish conditions you can have is when the S&P is above its 12-month moving average and the yield on commercial paper is below its 12-month moving average. So in other words, you've got declining interest rates and a positive trend in stocks. So stocks are responding to a declining trend in interest rates. For example, in 2007, 2008, we had declining interest rates, but stocks didn't respond because they remained below their 12-month moving average. So when you get that condition taking place, that's when we get these green highlights. And you can see that we've had some pretty good gains during a period when the commercial paper yield's been below its average and the stock market's been above its average. And right now we're in one of these positive conditions. It doesn't tell us how long it's going to last. Sometimes it lasts for a fairly lengthy period, like this one here in the mid-1980s. And sometimes it lasts for a relatively short period. Not too many of those. I mean, there's a couple of false signals there in 2006. But the fact that it's gone bullish, the stock market's responding to lower interest rates says to me that the lower interest rates are going to give us a recovery, a renewed recovery, I should say. And the stock market is actually starting to discount that right now. So that makes me very bullish. And when this indicator has been in a bullish mode, if you take the monthly S&P return and annualize it, it's been something like 16% between 1900 and I think it was like 2009, 2012 or something like that. It was a very long period, at least 100 years. So it's been well tested in the last couple of centuries. So here's one of the components is the 3-month commercial paper yield. That's what we have here. And you see we got a little bit of a red highlight here indicating that yields are likely to head lower. And that's because this indicator here is below zero. And this indicator monitors a combined momentum of both the commercial paper yield and commodities, because interest rates are very sensitive to trends in commodities. So if you combine an indicator with interest rates themselves and commodities, and when it goes below zero, that's when we get one of these red highlights. And you can see that it's captured pretty well all of the down moves that have taken place since the beginning of the chart, which is in the 1920s. So that's a pretty good sign that we're likely to get lower rates. It doesn't tell us when it crosses below zero how long we're likely to stay there. Because in some cases, like this signal here in 2010, 2011, it didn't last so very long. Same with this one up here in, what's this, 1996 or something. But most of the time when it goes bearish, rates fall for an extended period. So the fact is that it's bullish now, and it does kind of back up the idea of what we're looking at in the previous chart, that rates are headed lower, and that should be positive for stock prices. What's also positive for stock prices is an indicator which hasn't quite yet gone bullish. So in the top panel, we have the S&P composite, and underneath is the long-term KST, or long-term smooth momentum, of the inverted dividend yield. And these vertical lines, once again, tell you when this KST, or momentum indicator, bottoms out and actually crosses above its moving average, which is a 9-month moving average. And each time you get a signal, you look to the right of the signal of the vertical line, you can see what happens to the stock market. It goes up. But we can take this indicator back to the 1880s, and we've had 42 buy signals, 5 of which have been failed signals. 47 signals, 5 of which have been failed signals, 42 of which have been positive signals, valid signals. So it's had a pretty good track record over a very long period of time, and kind of backs up the other indicator we were looking at, except to say that it needs to cross above its 9-month moving average, and it's just not quite there yet. So I'm watching this one very, very carefully, because it is a very reliable indicator. So let's say a few words about the economy now. When we look at the economy, we want to look at long leading indicators that have had a long-term consistent record of peaking out before recessions. So in this next 2 or 3 series of charts, what I've got is a lot of indicators where we have some red highlights, and those red highlights indicate recessions. And you can see this chemical activity barometer, which is a leading indicator put out by the American Chemistry Council. And it goes back to the 1920s, and it's led every recession since the 1920s, with an average lead time of around 7 months. I think it's been as long as 14 months and as short as a couple of months. So as you can see here, this indicator is, before this recession in 2001, obviously peaked quite some time before, came down, crossed below its moving average, and then we finally got a recession. And the same thing happened in 2007, 2008, gave a signal just here. And when it crosses its moving average, that often gives you a timely signal that a recession is now underway. Fast forward to the present situation, and what we can see, if we start off here, going into the recovery phase, we had a slowdown in the growth rate. This is the price oscillator of the indicator. And by the way, the indicator includes a lot of chemical industry data. So it's kind of different from, it does also include some housing permits, I think, or housing starts, and some generalized US indicators that are followed by other leading indicators. But it has a lot of unique stuff, unique to the chemical industry as well. So it kind of acts as a cross-check to some of the more popular leading indicators that we follow. So anyway, I'm pointing out that since 2009, we went through a slowdown in the growth rate, but we didn't cross below the moving average, indicating the possibility or the probability of recession. And then it recovered and started to rally for 2 or 3 years. And then it came down again into 2014, 2016 for another slowdown. Again, it didn't cross below its moving average. And then we have another one since late 2017, early 2018, when the NYSE and the global stock markets peaked out around this point here. But the growth rate has been slowing in the last 18 months or so. Now the oscillator is broken above this green downtrend line. I think it's a positive sign, but it's not a unequivocal sign that we're not going to go into a recession. But it's nevertheless a positive sign. Also positive is the fact that the indicator itself, which leads recessions, if you remember, is almost back to its previous high. I think it's about, the indicator is 122.83, and I think it was 123.13 or something was the previous high. So it's much closer to its high than its low for the slowdown, and it's still above its moving average. So I'm encouraged by the fact that it's held up at this high level. We're going to get a recession. It's going to be down the road. It's not like to happen right away. Next economic indicator we're looking at is the Pring leading economic indicator. It goes back to 1957. Once again, the red highlights represent recessions and the vertical lines represent the points when the recessions begin. And the indicator has been pretty consistent in leading every recession we've had since the 1950s. So one major blunder was also leading the recession of 1966, which was not a recession. It was a growth slowdown. It was not a recession. But let's take a closer look at one of the ways in which we determine whether or not we're in a recession territory with this indicator is to look at the recession caller, which is essentially a momentum indicator of the raw data you're looking at in the top panel. And when that crosses below the red recession calling line or recession triggering line, that's the time when we would expect to see a recession. So let's just take a closer look at this with more recent data to see what's happening to this recession caller line. Oh, I should point out that the indicator includes housing, consumer, employment, and stock market data, all weighted according to their volatility and so forth, and their influence on the economy. So it's not a simple average of the four. It's a weighted composite. So now here's the more recent data, and you can see once again the leading characteristics are fairly consistent as we go through. The leads and lags, of course, vary in each cycle. But what we saw last month is the estimated total actually made a new marginal high in September. And if you look at the recession triggering line, instead of moving down towards a recession, it's moving up towards a re-recovery again. Now, it could happen that we will see one of these situations like we saw in 2006, 2007, where the indicator looks like it's pulling away from recession and then starts to fall down into a recession. And we saw a similar thing in 1989, where it held up very nicely and then moved down at the last moment. But as the facts stand at the present time, it's moving more towards recovery than recession. And if it's going to go towards recession, we'll see this thing start to move down ahead of a recession. Our third final leading indicator is one which is public available, like the chemical activity barometer. This is the ECRI weekly leading economic indicator. And once again, the green lines, the red highlights represent recessions. And at the bottom, we've got some technical measures for this leading economic indicator. Because as you can see, like the chemical activity barometer, it's been in a bit of a ranging action for the last couple of years. And recently, it bounced off this support trend line here and this long-term support line that started when the recovery started in 2009 or when the recession was at its deepest in 2009. And it's also now moved above this dashed trend line here that we've got. I'd like to see it move a little bit higher before concluding that it's avoided a recessionary signal. But look what happened in the past. When we came out of a recession, we could see a trend line break in the indicator and a triple trend line break in these three rates of change. Then we saw the 2011-2012 slowdown, a breakout from that, preceded by a breakout in two of the three trend lines, and then a more of a coincident break in the 18-month rate of change. Then when we came to the second slowdown out in the post-2009 recovery, once again, we see a breakout both in the index and in the price series. And then finally, in the current situation, we can see a breakout's taken place in two of the, and I use the word tentative because it's not yet really decisive. In two of these series, it's broken to the upside. So to me, that looks fairly encouraging. But the next chart is going to show you a leading indicator of this leading indicator. And that leading indicator of the leading indicator is actually turned up. So here's the ECRI once again. You can see the tentative breakout that we had here above the green trend line. And then here's my economic diffusion indicator. This one monitors a basket of leading economic indicators that are above a specific moving average or in a positive trend. And the vertical lines here represent periods when this indicator has bottomed out since 1967. And if you look to the right of the ECRI, you'll see in pretty well each situation, we see some kind of a rally taking place or some kind of, in this case, recovery taking place, except for three instances, one in the 1990s marked by these red dashed lines, one in 2001, and another one in 2006, 2007. This indicator has been moving up smartly for the last few months. And incidentally, it's also a very good indicator for the stock market as well. So there's another bullish indicator for the stock market. So this indicator looks like, excuse me, it's headed higher because the raw data in this gray here, I don't know if you can see it, but the raw data is also very, very strong and indicating that there's unlikely to be a reversal in this blue indicator, which is a 6-month moving average, anytime soon. Now we're going to turn to the bond market, and here is a supply series between 20-year and, since the 1990s, 30-year government bond yields. We're looking at this data from the 1870s, and what we have here, well, the reason I'm showing it to you is because we have an oscillator down the bottom which divides a 60-month by a 360-month moving average of this spliced bond series. What I'm trying to point out is that when the oscillator is in a bullish mode above its moving average, that's where we get one of these green highlights. And that indicates that the secular trend for interest rates as measured by this model is in a positive trend.
Hey, Mark, as you can see, slide that over just to the right a bit. We can't see the final column on the chart, like the last data point.
I can't see it either, Greg.
Oh, okay.
Oops. So I think something must, oh, maybe I can go back and maybe I didn't mount it properly. I think, yeah, there you go. I don't know what the problem is.
You should be able to click on the chart and just shrink it.
Yeah, let's try that. Because this is a pretty important long, I don't know why it's not showing up.
Okay.
Anyway, the point was that this is getting very, very close to a buy signal. It wouldn't take much to turn this into a buy signal. And if you had the latest data, you could see that it's right back down to the this previous secular low in interest rates. And it's also below the downtrend line here. So let's take a closer look at some of the bond market series, which I think is going to show up all right. Yeah, it does. I apologize for that. I don't know why it didn't show up. But the point I'm bringing up this chart is to show you that we've been in a secular, in the previous chart, we've been in a secular bear market for yields. But not all yields are, and we were down at a new low in the 30-year, as you can see here in September. But not all bond yields made new lows in 2019. Some of them made lows earlier on, like the 2-year Treasury made its low in 2011. The 5-year made its low in 2012. The 10-year made its low so far in 2016. And the 30 years made its low, a month ago, just over a month ago. So the point being, as this secular trend has been materializing, fewer and fewer maturities have been participating. And as we'll see later on, the 5-year Treasury has actually been experiencing a series of rising peaks and troughs. Also, one reason for expecting Treasuries to be rising in yield from here is the fact that the 10-year has moved down to this support level. So it came down here in 2012, came down here in 2016. It's very oversold now, as we'll see when we get onto the StockCharts platform, and is due for some sort of a bounce here. So now we're looking at the CRB spot raw industrials commodity prices, because we need to see commodity prices move up. We're going to see yields move up. And the vertical lines show you the lows in the long-term KST for ISM prices. Now, the latest data came out a little bit earlier this morning, and I didn't get a chance to update the chart, but it's basically the same. It's very slightly lower, so it hasn't turned to the upside yet, which if it did, would give us another green vertical line, and that would indicate that either commodity prices are likely to experience a nice rally, a bull market, or some kind of a trading range market. That hasn't happened yet. We're watching out for it. But I've got a couple of other leading indicators for commodities, which I'll show you a little later. I also wanted to point out that if it does start to turn around from just below here or around here, there is some resistance up here in the form of a potential, and I emphasize the word potential, inverse head and shoulder. That would be the shoulder, that would be the head, and that would be the right shoulder. So we've got two leading indicators I'm going to talk about very briefly here for commodity prices. One is gold, and here we see the gold price, and underneath the gold price is the CRB spot raw industrials. We've got two KSTs, one's for the gold price and one's for the CRB. So in other words, one's for gold and one's for commodities. And what we find out is that the brown line, which is the gold KST, often leads the blue line, which is the CRB KST. So that's what these green arrows are. It doesn't happen in every cycle, and sometimes the relationships get completely out of kilter. But there is a tendency for the gold price to lead commodity prices, and of course the gold price has been moving up recently. Its KST has been moving up, and as you saw in the previous chart, and as we're seeing here, the KST for the CRB spot raw industrials has been coming down. So we don't know what the lead time is, but the conditions for a turnaround in the commodity markets are falling into place. Another thing I look at is the relationship between gold and the CRB. When the relationship is rising, that tends to be bullish for gold and bearish for commodity prices. But when the KST for the ratio of gold to commodity prices starts to peak, that's when we get one of these green vertical lines each time the KST is peaking. Failed signals would be when we get a red highlight. And a failed signal would be when the commodity market fails to rally. But most of the time, when the indicator peaks, commodity prices either go sideways or they go up. Right now, there's no sign of that because the gold is still rallying, the ratio is still rallying, and the KST is still rallying, so we don't have a signal. We do have 2 points that suggest we may be in the process of getting a signal. One is the fact that it's the ratio is back to resistance, and the other is in the next chart, which shows the same ratio again back to its high, previous high. But look at the short-term KST is in a bearish mode, and the intermediate KST is in its bearish mode. That doesn't tell us that the ratio is reversed on a primary trend basis, or that KST is going to turn, but it does suggest that the ratio is unlikely to push any higher. And given its relationship with commodity prices, it does suggest that we're going to get some kind of a consolidation or maybe some kind of a near-term rally in commodity prices. Finally, another leading indicator for commodities is lumber. Industrial commodities is lumber, because lumber is tied into housing, and housing is a leading indicator because it's tied into it's very interest sensitive. So why is that important right now? What we're seeing is a potential base with the short-term KST in a positive mode and the intermediate KST also above its exponential moving average, although it's hesitating very slightly. But the momentum suggests that we're going to see an upside breakout. Why is this breakout important? Let's look at the next chart. Because it's right at this very, very long-term trend line. It goes resistance line. It goes back to 1992. And it broke out in 2016, 2017. The breakout failed to hold. And now we're challenging that breakout again. So if that that trend line in this previous chart here gets broken on the upside with a lumber price above $400, that would be very positive, obviously, for lumber. But it would also be positive for the CRB spot raw industrials. Because once again, the green KST represents lumber, and you can see it's just starting to turn here. A breakout in that chart before would ensure that it would be a solid breakout to the upside here, or a solid move to the upside. Why is that important? Because there's a strong tendency for lumber, since it's tied into housing, and housing is a long leading indicator. It's also tied into the CRB spot as well, into industrial commodity prices as well. So that is tentatively positive for commodities. What I'm saying is, as you can see here, the CRB spot is below its long-term moving average, so we can't get bullish. But we are seeing a couple of indications with the gold price and with the lumber, which kind of indicates there could be some chinks in the armor of the primary bear market in commodity prices. And we know from looking at the long-term KST for the ISM in manufacturing prices, that was at a very overextended level, as the chart I showed earlier. And that also suggests that there may be some cap put on or limit on the downside of commodity prices here. So now I'm going to final up before I get onto the StockCharts platform with what I usually do, this schematic diagram of where we stand with the various sectors. So what we're going to look at is a chart which monitors the long-term KST of a lot of different sectors, as well as the stock market, bond market, and the commodity markets. And what we do is it categorizes into 4 different segments. Fall, when the long-term KST is literally falling. Winter, when it's below zero and falling. And then spring, when it's below zero and rising. And summer, when it's above zero, which is kind of like the market phase when it's above zero and rising. So we're going to look at all these sectors and things to see where we are in the cycle. One of the things to note is that if we're looking for a stock market peak, we would expect to see a concentration of sectors and the stock market itself in this period here, in what we call the fall period. And if we were looking at a major bottom, like we saw in 2003 and 2007, we would expect to see a concentration of all these sectors, all their KSTs down here. So let's just take a look at where we are right now. So here we have the 4 sectors: fall, winter, summer, and spring. And this is where the bond market is right now, as measured by the iShares 20-year plus TLT. It's in a rising phase. The stock market, as we'll see when we get onto the stock markets platform, is over here. Last month it was over there, and now it's sort of started to move because it's started to turn up. So instead of moving into winter or spring, it's kind of a straight transition from fall into summer. And this is what we call an Indian summer. Because an Indian summer is kind of like the last legs of the bull market. Well, or last legs of a real summer. So when we have a move from this section over here, fall, to summer, that indicates that it's probably the final gasp of the bull market. Bull market, nevertheless, but the final section of it. And then commodities, as we saw previously, are over here with their KST. So we've got a nice little progression here: bonds leading stocks, leading commodities. This is what we would normally expect to see. So I'm going to put up the early cycle leader sectors and the late cycle leaders. First, the early cycle in red, and these are the positions on the long-term KST where they are. So with the early cycle, we have a concentration over here in the summer period, and a few in the spring, or just telecom in spring, and biotech in the retail. So when we look at the late cycle leaders, once again, we see a similar kind of a makeup, where there's a concentration in the summer. So they're most of these sectors now are in the group sector. What's been happening in the last couple of months is they've been transitioning from this point here to that point there, avoiding a lot of these sectors, avoiding the winter and the spring position. So here is September, where we saw them last month, because they were all in this position here. And we saw them move financials, consumer consumer durables, and industrials were over here, having in August been over this side. So let's just go back again to where we are. This is September. These are the groups that have switched from here to here in October. These are the ones that switched from August into September, which is why they're over here in September. And let's go and see go and compare that again to where we are now. And those same groups are now switched back again, indicating that they had a slightly lower KST and then a slightly higher KST. Now they've got a slightly higher KST, and we're over the predominant number of sectors, and as well as bonds and the stock market, we're over here in the markup phase. What that suggests to me is that we're in a bull market, but because we're up here, as opposed to triggering all these signals from down here, we don't have as much potential as if everything was concentrated down here. Where it's going to be a bull market nevertheless, and it's not going to tell us how long that bull market's going to last, or how high it's going to go, but it does suggest that prices are headed higher unless we get another quick move back to this side here. We'll take a look at that as we move into the StockCharts platform, which I'm going to try and find here. So any questions so far, Greg?
No, I think the one thing that surprises me is how many are sitting in the summer position.
Sorry, I'm just trying to get myself positioned here. Okay.
There we go. I can see that.
So here's the NYA, which has not been as strong as the S&P, and here is long-term KST in the bottom window, and you can see it's just starting to turn up. But the COPOC indicator for the NYSE has turned up more decisively. Again, it could be that this is a false move, and we're going to see an October sell-off. You could make that case, and it wouldn't take much to push it down. But right now, it's in a bullish mode, and historically, when it's been in a bullish mode, except for 2002 here, when it went slightly not quite as bullish as it is now in terms of the angle of upside, but it did turn down. But generally speaking, it's been a pretty good indicator. You can see also that if the NYA can rally above the high of a couple of months ago, it would have completed a reverse head and shoulders and be off to the races. We've also got it above its 12-month moving average. I wouldn't place too much on that because it's basically been a trading range, and in a trading range, you get whipsaws with a moving average. I'd be more inclined to look at this low, I think that was the May low, the May closing low, as a benchmark rather than the 12-month moving average for the NYA. So let's move on and see what else we got here. This is my Dow Jones diffusion indicator. It monitors a basket of Dow stocks in a positive trend, and the green arrows represent periods when it reversed from below this green dash line and moved higher. And each of these situations recently, we've seen a nice rally take place. We've also seen a rally take place from the previous signal, but we're also seeing it's still bullish because it's above its moving average, but it started to ever so gently turn over. So that is a bit of a worry. But once again, what I want to see is not so much a sell signal from this, because it's not coming from a very high level, but more a break in, say, this trend line on the 200-day moving average. The 200-day moving average is at basically 25,500. If it gets below that, that will begin to get my attention. Right now, I think, as I pointed out before, most of these indicators are tentatively bullish. Here's what I call a confidence ratio, where we divide the HYG, the iBox high yield bonds, against the TLT, which are the treasuries. So when it's moving up, it means that people are moving into the high yield. They got confidence, and when they got confidence, that usually spills into the stock market. The green lines represent oversold situations where people got very, very pessimistic because they were throwing away the high yield bonds, the HYG, relative to the TLT. And usually we get some kind of a nice bounce from that, and that's in fact what happened. The other signal is by the blue arrows, and that's when it reaches up to a very high level. And when it reaches up to a high level and then reverses, as it did recently, usually that indicates that there's a lot of underlying upside momentum in confidence. And you can see that in several of these situations, even though it was overbought, we got a very nice rally following, because it was it had a lot of upside momentum going into that peak. A couple of the others, this one here and this one here, didn't result in much, reversing from a high level. Weren't followed by much of a rally. but they certainly weren't followed by a decline either. So in all these situations, none of them, even though you got into a very overbought situation, none of them were followed by a serious decline. Some by a sideways movement, but most of them by a nice rally. So that encourages me to think that the market's going higher. Now we have the ratio between stocks and bonds, which I admit looks a little ominous here because it could be a large head and shoulders top. But I said the words could be, and until it breaks below, or the ratio breaks below the 19 level, we're going to have to say, as far as the downside action is concerned, it's still in a trading range. So it could just as easily break to the upside. So this is another chart I'm watching very carefully, because if it breaks above that trend line there, the green trend line, that would be a very positive development for stocks relative to bonds. And when stocks beat bonds, usually that means stocks are going up in their own right. So that's kind of a neutrals chart at the moment. And we're going to now move on to the bond market. Here's the 10-year yield. This is the chart I've shown several recent webinars. It's a 52-week rate of change. We're looking at it when it reaches or approaches the red upside overbought line, or the green oversold line. That's what these arrows are when we get reversals from those extreme levels. And if you look at the action, usually we get a sell signal, it comes down. Usually we get a buy signal, it goes up. So right now we're really oversold in the 10-year on the downside. And the 10-year, as I pointed out in the previous chart, is just at support here in the area of its 2012, 2016, and 2019 lows. And so anytime you see something which reaches very important support and it's extremely oversold, that's usually a time to expect some kind of a reversal. You notice a couple of dashed arrows here, the dashed arrow green here and a dashed arrow red here. Those show failed signals. So it shows this is not a perfect approach. But my goodness, when you look at the odds of one of these reversals, what's going to happen after one of these reversals, the odds favor a strong reversal in trend, even though there are these two exceptions. Because in technical analysis, nothing is perfect, nothing is guaranteed. There's no such word as always. But there's a word which we use a lot, which is probabilities. And when this starts to turn around and reaching support is a good time for expecting that, the probabilities would strongly favor yields rising. This next chart just basically shows you the same thing on a monthly basis. And instead of the 52-week rate of change, we look at a 12-week rate of change. We're going back a bit more in history because we've got one more signal here. Not too much to be learned. Except if we're looking for a reversal on the secular trend, it really needs to come, the yield will really need to bounce above these levels here, which is the secular downtrend line and the line marking this potential base. We're obviously a long way from that in terms of this chart. Here's the 5-year yield, which bottomed 2016, just here, 2012. And it's been experiencing in 2016, it had a higher low than 2012 and had a higher low than it had in 2019. So this is all good stuff suggesting that for the 5-year yield, as opposed to the longer term maturities, like 20 and 30 years, the secular trend has been reversed because we have a series of rising bottoms and rising peaks. And once again, the 5-year is pretty oversold here. This is my bond net new high indicator. When it gets to a high reading and starts to turn down, there's a good probability bond prices will turn down, and then obviously bond yields will turn up. And we've had 3 sell signals, and none of them have registered much on the Richter scale in terms of downward moves. There's been a little consolidation and maybe a little bit of a downward move after each of these. But now we got a 4th one, and sooner or later, one of these signals works. And so I think it's a dangerous period to be holding bonds here. I'm not looking for a serious decline in prices or serious rise in yields at this point, but I think the bond prices are a little vulnerable here. Here's something I'm watching fairly closely. This is the ultimate inflation-deflation ratio, where we're looking at commodities, the CRB versus bonds, which is the IEF, the 7 to 10-year Treasury. A rising ratio is inflationary because it means that commodities are beating bonds, and a declining ratio is deflationary because it means that bonds are outperforming commodities. It broke down from a pretty important trend line back in earlier this year, and has so far managed to stay below that trend line. But and that trend line is also intersecting with the 200-day moving average. So when they get and you also got this red trend line as well on the same area at around 166. And when you get a couple of trend lines on a reliable moving average all in the same vicinity, that represents incredibly important resistance or support. In this case, it would be resistance. And if that were to, right now we have to say the trend is deflationary because that breakdown is still in force and we're below that resistance. But if the ratio, which you can calculate very simply by dividing the CRB composite by the IEF, and remember to put an underscore before the IEF, otherwise you'll include dividends, which will give the bond price an artificial advantage. If we do get above that 166, say the 170, 175, excuse me, that would suggest to me that this is a false breakout, and that will be then quite inflationary. But right now it's in a deflationary trend, and we have to respect that. Here is the CRB composite with my inflation-deflation ratio. This is where the stock market has its say in inflation versus deflation. You always have two ratios, the exclamation mark PRII, which is the Pring Inflation Index, which is a group of an index comprising 4 different sectors or industry groups that are earnings driven or sensitive to commodity prices. And we have the deflation index, where we look at defensive groups and we divide the inflation by the deflation. As you can see, it tracks the CRB composite pretty well. So that's the stock market's way of voting for inflation sensitive stocks or deflation sensitive stocks. And as you can see in recent action here, both these series, there's a CRB composite. It looks like it's forming an inverse head and shoulders. I say looks like because if it doesn't form the head and shoulders and it breaks above this purple line, that would indicate a failed breakout. If that was confirmed by the stock market with the inflation-deflation ratio crossing above its equivalent purple line, that would set the signal for an inflationary rally. And that would obviously be bullish for inflation-sensitive stocks and obviously be bullish for commodity prices. But right now we're in that trading range. I've shown this chart several times in the last few webinars. Maybe it's a little boring, but it's certainly something worth watching out for, because if we get a break in either direction, that could be pretty simple. That's pretty significant. And if you look here, you can see the KST ratio is below its moving average, but it's hardly, this is the ratio, it's the KST for the ratio. It's not decisively bearish at this point. So I think I'm going to wrap up now, Greg, and see if you have any questions.
You know, Martin, I have quite a few questions. Some of the main issues that you know, when I look at the commodities, I see oil, you know, continuing to fall, and that just seems to be such a strong economic indicator that I can't help but be concerned that oil is telling us things are a lot weaker than we expect.
Yeah, well, oil is a very crucial, obviously a very crucial commodity, and if you track it over 50 or 100-year period, you see it moves fairly closely with the CRB composite.
And what about with the stock
industrials? And you see the same thing with copper as well.
Yeah. It just seems to me like that oil price has been so weak that it's, you know, clearly after the Saudi attacks, I would have thought more strength would have shown there, but it's breaking down. And normally, just because I live in a commodity city, I see when the oil price gets weak, you know, it doesn't take very long for the economy to roll over. So 2014, we had a weak oil price in September, and then the market tried to hold up, and by, I think it was May, it started to roll over. So we've been living with a lower oil price here for a while. and it continues to decline. So I'm more worried that the oil price is telling us a lot more about global economic activity, and things are starting to fail. So I'm less comfortable that things can go higher.
Is there any particular chart you'd like to look at to make that point?
Just if you had the West Texas, if you can find an S&P chart and then just put the West Texas price on it. So, or that one will work great. That New York composite right there. So,
What's that?
yeah, sure.
What's the symbol again?
Dollar sign WTIC. Yeah.
WTIC. And we're going to put the word long in there because we
Yeah,
want
that's
to.
good. And then just set the chart to 5 years or something, so, or 10 years.
5 years. Let's make it 10. I should have made it a little bigger. Yeah, make it a little bigger. Height 1.
There we go. So in 2014, we saw the price of oil drop, and I guess that's a convenient place to look. But back in April of 2011, we saw oil drop off quite steeply. Took the market till July to fail,
Okay,
and then
let's just put this in here. 2014.
Yeah. So oil. So if you just go to the July peak in oil, and then as oil fell, the stock market didn't do anything, and then we had the bounce in all the way into May, I'll say. And then that's kind of when the stock market peaked in May, and oil had bounced back up in the meantime and then fell down again. So just the weakness in oil seemed to be telling us that, things aren't getting stronger. And we saw the same thing in 2011 and in 2012.
Kind of looking at this, right?
Yeah, I see that one in a big way.
There's one big difference between now and then. And let me show you what I see. I mean, if that breaks this trend line here and down below 50.49,
Yep.
you got weak oil prices, no doubt. And commodity prices, as I mentioned, are in a confirmed bear market. But let me just put this up a second. WT.
And while you're doing that, I will say that one of the things I'm concerned about, I mean, obviously, if we get some sort of a trade agreement with Xi next week, coming out of China over to America to finish the trade discussions or keep them going, that I think would be very bullish, and I would be aggressively buying the industrial metal complex and stuff like that. But I just
look at the charts, though, Greg.
Yeah.
Okay, so here's your 2014.
Yeah.
Here's your 2014.
Yeah.
And it's very similar in the sense that they're both going. The KST down here is going sideways.
Yeah, and just we have, the U.S. XOP index, or the ETF is at 13-year lows, and the OIH is at 20-year lows. Those are extreme levels. So, I'm just postulating that it seems like oil does as an economic traveler or economic source, it can be helpful. XLE is now clouded by a lot of solar and nuclear power, so it's not as
well. It's got the same similar pattern to the oil.
Yeah, so it's still similar, but you can see it's held up a lot better than the price of oil.
But it's not, in some respects, it's not dissimilar from the CRB that I showed you, where it's a potential head and shoulders there. It's just happened from a higher level, and it goes back. I guess go back to the same time. So, what would you put up instead of the XLE then?
The XOP is the exploration and production ETF. That one works pretty good.
Dollar XOP?
Yeah, no, just XOP. It's an actual ETF.
Oh, it's the ETF.
And that chart is breaking down hard.
It's broken down hard.
Yeah, and the problem is that even on try and find a the world's biggest bombing attack on crude oil in 20 or 30 years, and it's not even on the chart. So it just had no bounce there whatsoever. And I actually will continue to watch oils just to see if if the inventory draw starts to show up, and then all of a sudden oil starts to climb in price again. But clearly we don't have any of that going on yet, and I'm watching it on a weekly basis. But this chart says everything about it. I mean, when this is so weak that we don't need more oil, I think that's a real concern.
Do you have any views on the economy?
Well, all of these manufacturing indexes keep pulling down, and I think people keep waiting for a trade deal to live with it. But I'm starting to see a whole bunch of you have long-term charts there where you place your seasonality, fall, winter, summer, spring. When I do that on a weekly chart, I've got lots of stuff rolling over, and it's really I was surprised at how early it rolled over. Just as the S&P tested a prior high, it failed, and I think we're going to start seeing some economic slowdown here. Again, waiting for the recession. Usually the stock market's priced that in long before. So I'm expecting that we might have already made our final high here for a while, and we're pulling back hard because the data, 2 weeks ago, I was very bullish. It was bouncing nicely. And then all of a sudden, literally, as we went up to the prior high, everything just rolled right over in terms of momentum. All of the sectors started to fall down. XLI, the semiconductors, the transports, the railways have broken their uptrend. The NASDAQ 100 has broken their uptrend compared to the S&P 500. All of those things are really important relative strength indicators to me, and they're starting to weaken dramatically. So I'm much more concerned that we don't have any structural power here to go higher.
And what about gold?
I think gold goes lower. I think the bonds have gotten so far ahead of themselves that whether it's a 2-month or a 3-month pullback, I don't know. They just look like they've already kind of had an exhaustion move and just need to come down and reset in terms of momentum. And I think gold might just follow that. It doesn't seem to have. It's been following the Japanese yen pretty closely, and usually. When we see the yen rise, we see gold rise, and we see bonds rise, and tips rise, and that kind of stuff. And now all of a sudden, they all seem to be pausing or rolling over together. So I think gold just pauses here for a while. I'm not predicting a big bear market in it, but I think gold will just pull back to whatever 1,500, down to 1,350, something like that. And I'd be watching for the base to set up at that new level.
Yeah, I'm inclined to agree. It's a bull market, overdue for correction.
Yeah, so there's lots of good things I like out there, but I could not believe how fast my data stalled on this most recent rally. Literally, when I'm trying to get, the whip between April, May, June, July, August, September, down 1 month, up 1 month, down 1 month, up 1 month, down 1 month, up has been some of the more volatile. Like if you just look at the momentum indicators on a weekly chart, that swing range, whether it's your KST or the PPO, the swing range has been some of the biggest ones over the last 5 years. It's really been indecisive, and I think that's another thing that leads me to believe we've probably got some more issues there. But anyway, we should probably wrap this up. Thank you, Mr. Pring, for taking the time to talk to us today.
Okay, thanks, Craig.
Bye-bye.